Hello and welcome to the Friday market update. Well, the Fed cuts rates and then the mortgage rates went up. So yes, the Fed finally cut the Fed funds rate 0.25%, and then mortgage rates have drifted up since then. So a whole bunch of buyers who were waiting on the sidelines, waiting for the rates to drop, well, they got caught a little bit flat-footed. We're still not bad. I'll take it. Mortgage News Daily says rates jumped to 6.35%, even though the Fed fund just cut it 0.25%. So what's going on? It all goes back to how Wall Street works. So the market moves in anticipation of what the Fed is likely to do. So back on August 22nd, Jerome Powell, the Fed chair, signaled that there was a rate cut coming. It's imminent. And Wall Street reacted almost immediately. Mortgage rates started to drift lower since that announcement. And then they came all the way down to about 6.25% before the rate cut. Then the rate cut comes and they drift back up again. But because of that, there was nothing new to get excited about. No fresh new data, no surprises, no reason to hold on to risky bets. So the traders locked in some profits, sold off some mortgage-backed securities, and it pushed the rates up a little bit. I think they're going to come back down over time. But I think for now, Wall Street is in a bit of a holding pattern, waiting on the next round of inflation, jobs data. And until then, just expect rates to stay in this zone, this sideways zone for a little while. So meanwhile, I posted on Instagram and TikTok about, like, wait for this, is an amazing topic, 401k loans, 401k withdrawals. And it got over 500,000 views and counting. So apparently I'm not the only one thinking about how first-time home buyers can turn a retirement account into a home ownership jumpstart. But here's the deal. A lot of first-time home buyers think they're stuck because they don't have savings for down payment. But when you look closer, many do have money. It's just not in their savings account. It's in their 401k. So they may not have cash in the bank, and maybe they don't have a family member that's willing to gift out $5,000, $10,000, $20,000, but they've got retirement savings because of the forced contributions. It's taken out of their paycheck every single pay period into this account, and a paycheck deduction, they don't even notice it. They're so used to not having that money, they don't spend it. And then it adds up in that 401k account. Some people don't even realize they have $10,000, $20,000, $30,000 tucked away in the 401k until I ask that question. Now, this is where people freak out on me. They go, Bill, you can't rob your retirement account to buy a house. And you know what I say to that? Hogwash. Yes, you can. And in some cases, you probably should. So let's look at a simple example to really show you what's going on. So let's meet Bob. Bob is 38 years old, which is the average age of a first-time home buyer now. He's got a solid job. He's got $5,000 in the bank. He's got $30,000 in a 401k. He's been living life, having fun with his friends, sporting events, nightclubs, shows, Uber Eats, you name it. He can spend money pretty well. He's not great at saving, but he's got that 401k. Now that he's a grown-up millennial at 38 with a little gray in the beard and the hair and all that, he wants to buy a $450,000 home, but he needs $20,000 to make it happen. So he has two options. Option number one, some 401ks allow you to borrow the money that you have in your 401k, 50% of the assets up to $50,000. So in this case, he has $30,000. He can borrow $15,000 and he adds $5,000 of cash that he has in the savings to that, and he makes it work. No taxes, no penalties. And this is the best part. He's borrowing his own money. People don't know this. He's borrowing his own money and paying himself back with interest. So it's a great little gig, and that would be the ideal situation. But some 401ks do not allow a 401k loan. That would mean that he could potentially liquidate that $30,000, pay a 10% penalty to take it out early, owe income taxes, but he would still end up with about $20,000 in hand. Now, I know that sounds painful to do that, but until you look at what the leverage can do, because it's all about leverage. So let's break it down. So if Bob leaves his $30,000 in his 401k and he earns 9% interest, which is an average of S&P over however many years, he would make about $2,700 per year on the $30,000 in the 401k. Now, if he uses a $20,000 after he's paid taxes and the penalties and all that, but he uses the $20,000 wisely, buys a $450,000 home. That home should appreciate at somewhere around 4% per year. It's higher than that over the last 60 years, is like closer to 5%, but he would make about $18,000 per year on appreciation. So what would you take? $18,000 versus $2,700. $18,000, and that's going to compound and get bigger and bigger over time. That's the power of leverage. So I'm going to give you another little example. Has anyone ever been on a teeter-totter? So imagine that. On one side, you have a little teeny tiny baby. That's Bob's 401k, $30,000. It's not huge. Then you have on the other side a sumo wrestler, the house. It's very big. You bought the house for $450,000. You're going to earn money on that $450,000. That house wins because you're leveraging. You're able to buy a $450,000 asset with $20,000 because of a mortgage. Now, over 10 years, Bob will likely be up by more than $140,000 over keeping it in the 401k by buying the house. And that's even after taking the penalty and paying the taxes. And he can still contribute to the 401k. I would highly recommend you continue to contribute because you got plenty of time. He's 38, and that will continue to grow. It's a great way to save. It's for savings. You don't miss it in your paycheck. Keep saving the 401k, but liquidate to buy the house. Now, this is another question. But what if the house doesn't go up in value? It's a fair question, but here's a stat for it because I'm all about data, all about stats. Home prices have stayed flat or increased in 75 of the last 82 years. So that's a bet I'm willing to take. It's a calculated risk. But guess what? The stock market goes up and down too, right? So one last bonus for Bob. So if Bob were to get married and he sells his house down the road and he sold it for $500,000 more than what he paid for it, which we see a lot, that money, that $500,000 profit is tax-free thanks to the capital gains exemption from home ownership. That's what home ownership can unlock. He doesn't pay taxes on the $500,000 gain. And if you have an IRA, or I'm sorry, a 401k, a traditional one, when you pull the money out, you pay income taxes on that. So if you have a buyer thinking, I don't have enough money saved for a home, but they've got money sitting in a retirement account, you might have, or they might have more options than you think. And that first step could change everything to get them into home ownership, building wealth for themselves, continuing to save in the retirement account. So reach out. I'll walk through your client, through all the numbers, all the scenarios, 5 year, 7 year, 10 year, happy to do that and build a plan, a smart plan that's advisable and get them moving where they want to be and where they want to go. So hope you have a great weekend. Thanks for listening. We'll see you next week. This is Gaylord out. Bye-bye.